Well, hello. We're down here at the river. It's a beautiful time to go fishing, and it's a beautiful time to talk about the conceptual framework. At least we'll talk about what we consider kind of level 3 of the conceptual framework. So level 3 of the conceptual framework is the basic assumptions, basic principles, cost constraints, and then at the end we'll kind of wrap up with a summary of the structure. So basic assumptions in accounting. So as you'll recall, we've talked about the different levels of the conceptual framework. We talked about the objective of accounting, and we moved on to the qualitative characteristics such as reliability and faithful representation. Talked about the elements where we walked through assets, liabilities, where all of those are kind of defined there in the conceptual framework. And now we are on to kind of the higher level, assumptions, principles, and constraints. So we're going to start out with assumptions, then we'll move on to principles, and last we'll kind of wrap up this section with a discussion of the constraints. Again, all of this is from the Statement of Financial Concepts number, I think it's 5 or 8. I don't remember right off the top of my head. Anyway, moving on, basic assumptions. We have 4 main assumptions. We have the economic entity, going concern, monetary unit, and periodicity. Starting with the economic entity. Economic entity, that was a horrible cast. The economic entity. So economic entity assumes that the company keeps its activities separate from its owners and other businesses. So it's somewhat straightforward that the company will need to keep its activities separate from its owners. Owners in companies, for an accounting purpose, need to be separate entities. So we talked about economic entities. Well, individuals can be economic entities, as can businesses. So the idea of economic entity is that there is some economic entity which we segregate out. We call that the business. And that business is what we are reporting on when we do financial statements. Now, that business can actually have multiple legal entities under it, yet it is all considered one business or one economic entity from an accounting standpoint. So, for instance, there is a large body of literature in accounting that seeks to discuss and work through exactly at what point in ownership does something become part of you as opposed to a separate entity or a separate economic entity. So if I own, say, 5% of a company, most people would say, well, if you only own 5% of a company, that is a separate entity than you. You would just record that you have some investment ownership in them, but they are not the same thing as you. Now, if you move to, say, 20 or 30 or maybe even 40% of a business, it starts getting a little bit less clear, especially in a business with otherwise a diverse ownership. 40% ownership in a business could essentially give you control of that business. Well, if you control the business, is it a separate legal entity? It is a separate legal entity. Is it a separate economic entity? Or is it basically just say your arm versus a different part of your business? So in that sense, we try to bring all these things together under one economic entity. So when you look at public company financial statements, you'll usually see, say, it'll be called the consolidated financial statements of an entity. And those consolidated means it's the consolidated entities, i.e. the entities owned by or controlled by the main organization. So we'll see that as we look through financial statements over the course of the semester, but they're almost always consolidated, which means they are all the legal entities that fall under the control of the parent. Now, you don't have to own 100% for it to be considered part of an economic entity. Generally, if you control it, it's considered part of your economic entity. And that does mess up a little bit of the accounting, or it makes it a little bit more confusing, but we'll talk through how that works out when we work through the financial statements at a later point. So that's the economic entity. Company keeps its activities separate from the owners and other businesses. Then we have going concern. The basic assumption of going concern is that we are going to assume that this company will continue essentially into perpetuity, or at least long enough to fulfill its obligations and utilize its assets or its resources. So that is what gives us or allows us to have short-term and long-term or current, non-current assets and liabilities. If we did not assume going concern, basically everything would be current. Everything needs to be done right now. We have no assumption that the company is even going to be around next year, let alone 10 years from now. So going concern, it's a major assumption. you'll often hear about going concern opinions, which is basically where an auditor issues an opinion on the financial statements, but it puts in a preface that this company may not be a going concern. There is substantial doubt that the company will continue to exist as a going concern. The reason for that opinion is that GAAP assumes going concern. So the auditor, if there's a risk that the company may not continue to be a going concern, they actually violate that assumption to some extent. However, the financial statements assume going concern, even though there's substantial doubt that that actually will occur. So the auditor just highlights that to the investors. Now, that type of opinion has kind of created a life of its own, where we hear news stories about companies receiving going concern opinions. Most of the research out there would indicate that by the time the auditor issues that, generally the investing public already knows it. It's already priced in. The information coming out, usually a lot of times at the same time, already shows that it's a going concern, and people are already going to be concerned about whether they'll be able to continue or whether they're going to be in bankruptcy. So from an accounting standpoint, going concern is just an assumption we have. That's what gives us current and non-current assets and liabilities. Monetary unit. We've talked about this in earlier discussions. The monetary unit is just everything gets broken down into a dollar. So the dollars are basis of measurement. So when we have inventory or fixed assets, we don't say we have a building, we say we have a building, and then the dollar value is what gets reported on the financial statements, not just say a 5,000 square foot building. We say we have $250,000 in the building. So that is what the monetary unit is, where we end up with so many issues or so many challenges with measurement. Because measurement, we have to take a building or a piece of inventory or something that is not naturally monetary, say for instance cash or receivables, which are essentially monetary units. We have to take something that's not automatically a monetary unit and convert it or measure it in terms of monetary units and then report it on the financial statements. So that is monetary unit. That is another assumption we make again. And then lastly, our last assumption is periodicity. The idea that a company can be divided into economic activities within certain time periods. So we kind of take that for granted, like we take many of these things for granted, but that is an assumption we have to make, that whatever, if we have a calendar year-end company, that we can measure its economic activities from January 1st through December 31st. That is one full calendar year. That is a period. That is somewhat of just an arbitrary, we just picked out that we're going to measure the financial performance or the economic performance of a company. We're going to measure that based on the cycles of the sun. We could measure it based on, or use periods of anything other than that, but that's what we use. But it is an assumption that we make that gives us some form of consistency, which goes into basically the philosophy of time, but that is beyond the scope of this course. So periodicity is the idea that a company can be divided into can divide its economic activities into periods of time. So those are our four assumptions: economic entity, going concern, periodicity, and monetary unit. Those are our four basic assumptions. We had some quick illustrations of those, more than what I just gave, or types of questions that I might ask you. So if we divide if we divide the activities into 12-month periods, that would be periodicity. If we don't adjust amounts on the financial statements for inflation, that's assuming monetary unit, because we're keeping something constant. We're not adjusting because the price of goods goes up. Everything's getting converted into dollars in the case of the US. If we have if a company reports current and non-current assets on its balance sheet, well, that's basically relying on the assumption of going concern. And then kind of lastly, companies that merge all of their subsidiaries under a consolidated set of financial statements, that is the economic entity assumption. So those are some illustrations or some outworkings of these assumptions within a set of financial statements. So if we move on to the basic principles of accounting, we have a couple of principles. First of all, the measurement principle. As I just mentioned when we talked about monetary unit, the measurement principle is taking things that aren't naturally denominated in dollars and now denominating those in dollars. That's measurement. We have to make some assumptions, or we have principles that guide us in terms of how are we going to measure things. So the two most common that we're going to run into is historical cost. That provides a reliable benchmark because historical costs generally didn't change. It's pretty solid, it's reliable, it's verifiable. We know, say, what we paid for inventory or what we paid for a building. That gives us the historical cost. However, that's not necessarily very timely, and it may not be relevant information today. If I bought a building 50 years ago, what I paid for it then is generally totally irrelevant to the financial condition of the company today. What's more reliable would be, or more relevant to an investor, would be what's the building worth now, not what it was worth 50 years ago when I bought it or when I moved in. So what we have seen a lot more moving towards in more recent accounting standards, say over the last 20 years, is this move towards fair value. So fair value, the idea is it's more relevant. So in the case of a building, which is still done historical cost primarily under US GAAP, but if you were to fair value a building, it would be valued on or measured on the balance sheet today at today's fair value instead of what you purchased it for 50 years ago. Most fair values that we've rolled in are for financial assets that have readily determinable fair values. Fixed assets, we don't typically fair value. Inventory, we don't fair value. So those are the two main ways of measurement, is historical cost and fair value. Moving on to revenue and expense recognition. So revenue and expense recognition, this is critical. This will come up routinely throughout the course. Revenue recognition requires that companies recognize revenue in the accounting period in which the performance obligation is satisfied. So at revenue recognition, if you're Walmart, the performance obligation of Walmart is to provide you with some product, say whatever, a bag of lettuce. If I'm going to provide you with a bag of lettuce, that is the obligation that you are paying Walmart to do. They have fulfilled that when you walk out the door with the bag of lettuce, which happens 30 seconds after you've paid for the bag of lettuce. That's pretty straightforward. Their performance obligation has been satisfied at the time you walk out the door with the bag of lettuce. Very straightforward. It's not so straightforward when you start talking about license agreements or long-term contracts. When is the performance obligation completed? It may be completed over a period of time. So let's say I purchase a warranty on a new car. So I purchase a 5-year warranty. Well, the service obligation or the performance obligation that I am buying and that is being provided to me is a warranty that lasts for 5 years. So in that case, the revenue is going to get recognized over the course of those 5 years. It's not going to get recognized when I drive off the lot in the new car that I just bought the warranty on, even though I paid for it right then. That revenue does not get recognized until the performance obligation is satisfied. Typically in the US, they would recognize basically a fifth of that every year until the end of that performance obligation or the end of that warranty period. So they earn that revenue, or they get to report that revenue as they fulfill that obligation, which is providing the warranty services to me as a consumer. Now, that's revenue. Revenue is focused on when the obligation is satisfied. Expenses, it's very simple. Expenses follow the revenue. Expenses do not get recognized when they're incurred. I can incur expenses and they sit on my balance sheet, and they haven't been expensed. They're just sitting there waiting for me to recognize the revenue. Inventory is a great example of this. It's really obvious, and most people would think, well, of course, that's how you do inventory. If I buy inventory, I have to pay for that inventory. So I've paid for the inventory. I have the inventory. It's sitting on hand. Why is that not an expense? Well, inventory is not an expense until I recognize the revenue. So it follows the revenue. I don't expense my inventory through cost of goods sold until I sell it. At the time of sale, the inventory goes from the balance sheet into cost of goods sold on the income statement and reduces my revenue. It's an expense. So expenses follow revenues. That is critical. Now, there's a couple things that make this a little bit less straightforward. It's always the same principle. Expenses follow revenues. However, some expenses can be easily tied to a future revenue, say inventory, very easy to tie to a future revenue. Other expenses, say the CEO's salary or the administrative expenses or the rent on the building where the executives have their offices, those are much more difficult to tie to a specific future revenue. And in general, if we are unable to, or it's very difficult to tie it to a future revenue, what we end up saying in accounting is, well, we're going to assume that those expenses are generating revenue in this period. So right now, And if they're generating revenue right now, they should be expensed right now. Those are what are called period costs. Product costs are costs that can be tied to or generate future revenue or future products. So that's kind of the breakdown of product and period costs. Again, it's still following the same expense recognition principle. It's just a little nuance when it's sometimes very difficult to tie expenses to a specific future revenue. In that case, we assume it's the current revenues that it's generating. So if we were to break down this kind of work or the revenue recognition principle on, say, a large contract. So let's say I'm a rental car agency. I just bought 100 cars from GM. So I buy 100 cars. I have signed this contract. I've agreed that I'm going to buy them. I've set the price. I have a contract. That contract does not create revenue for GM. Now, they're going to sell me those cars, and I'm going to also, let's say the contract also has a service agreement in it. So I'm going to pay whatever, $100 million. That'd be a lot for 100 cars. That'd be $1 million a car. Well, let's say whatever, $5 million something. I can't do that math in my head right now. Oh, anyway, what we've got here is we have a contract that's going to cover the price of the cars and the warranty. So at the time of the signing of the contract, no expense, no revenue. Nothing's really happened yet from an accounting standpoint. Now, if we move on and we say, okay, well now they've delivered the cars. Well, within our contract, we've bought cars and we've bought a warranty on these cars. So we need to split that out. So the car revenue gets recognized right away. The warranty revenue, that obligation has not been performed. It's not going to get recognized right away. So that's how that's going to get broken up. We will then recognize the warranty revenue when that obligation has been performed, even though it's the same contract. So this gets very complicated, as you can imagine. With the more complicated contracts we have, or revenue contracts, it's going to generate multiple types of revenue that all might get recorded or tracked very differently. So moving on to another basic principle, full disclosure is providing information that is sufficient importance to influence the judgment and decisions of an informed user. So this is provided through financial statements, notes to the financial statements. So we talk about the face, that being balance sheet, income statement, statement of cash flows, owner's equity. That's the face of the financial statements. Then we have the notes, which basically expound on the information provided in the face of the financial statements. And then there's also supplementary information. So there's a lot of information in this full disclosure. The idea is it should provide a complete picture of the company as best we can within the constraints of accounting. So that's basically full disclosure. We don't leave important things out of the financial statements. So what this ends up looking like, some companies have extremely long financial statements. I believe that Citigroup is still the record holder with an annual report over 300 pages. This is not 12 points double-spaced font. This is 300 pages of text and tables. It's a very long annual report. Interestingly, some other companies that you might not expect, for instance, Walmart has one of the smallest financial statements at just over 60 pages in a typical year. And that is because, well, one, Walmart has very brief discussions and disclosures. They're also a very streamlined business. They pretty much do one thing. They sell stuff. They sell retail stuff. That simplifies things. You don't need a ton of notes if you just do one thing. GE has a gazillion different things. It has very broad financial statements at well over 220 pages last time I looked. Citigroup also does a lot, and banks typically just have a lot of disclosures because there's a lot of extra information that ends up in bank financial statements. Interestingly, the University of Arkansas has an annual report of roughly 85 pages long. So University of Arkansas's annual report is longer, almost 25% longer than Walmart's annual report. So that's just an interesting tidbit, piece of factual information. So real quick, in summarizing these basic principles, we have our revenue and expense recognition, full disclosure, and measurement. Those are our 4 basic principles. At this point, you need to understand those and have a pretty solid grasp of at least what they mean and some of the applications that I talked about right here. So lastly, we're going to touch on the constraint, primarily the cost constraint. Cost constraint in accounting. Well, it would be great for a company to provide all their information. Well, yes, that would be great. Investors would love to have all of their information, with some caveats to that statement. But providing information costs money. It costs the company. One, it costs them time to accumulate and summarize that information. That information has to be verified by an auditor. That takes time and money. A lot of information that investors would like to have, the company doesn't even collect. They would have to actually go and collect new information to include to investors. Well, that's incredibly costly, so they wouldn't provide that. There's also indirect costs. A lot of companies have proprietary information. They don't want their competitors to know everything they're doing. They don't want them to know the margin or the markup on some of their products. In that case, disclosing it would actually put them at a competitive disadvantage to another company, because the other company would say, oh, well, that's how they're pricing things. How can we use that information to our benefit? Well, that's detrimental. That has a cost, not a direct out-of-pocket cost, but a cost in terms of future profitability that is going to reduce the revenues of the company. So those are constraints. That cost constraint is very meaningful. With that, we're pretty much all wrapped up. We've covered the conceptual framework. We talked about the objective of accounting to provide information, useful information to parties. We've talked about the qualitative characteristics, the elements of the financial statements, and then today we wrapped up with the assumptions, principles, and constraints that we have. This all forms our conceptual framework. It's this framework that is now going to inform how we account and report everything from here on out. Knowing and understanding this well will make the rest of the material much easier to comprehend and much easier to follow. You'll be able to come up with how things should get accounted for even before, say, I walk through and say this is how it's done. If you think through it from a conceptual framework standpoint, a lot of times you can get there even before I state the exact standards, just by following the conceptual framework. So I cannot emphasize enough the importance of understanding this conceptual framework. So with that, we're going to wrap up for the day. Great talking with you. God bless, and I will talk to you next time.